Well, hello everyone, welcome to Portfolio Growth. I'm Jake Pelly, and today is August 15th, 2019. As always, here's our fun disclaimer. This is being recorded. You can always view it at your leisure once I post the replay. Also, today's quote is on here twice by Michael Lewis. A banking system is an act of faith. It survives only for as long as people believe it will. Author of The Big Short. Really good movie, too. Let's see if we can get rid of this. There we go. Yes, let's save that. So how's everyone doing today? I'm doing pretty good. Weather seems to be alright here in Fresno. Trading seems to be pretty sideways after the last couple days. And then right before I started, it absolutely moves lower. You can see the S&P 500 moving lower, the NASDAQ moving lower, and the Dow Jones all moving lower. We had a couple winners and losers today in the market. You can see Walmart posted some pretty good earnings, and we had Cisco reporting pretty bad earnings. So Walmart being good on the consumer, still looking to be strong on going into debt and buying products, so it's good from Walmart. And Cisco had a pretty big earnings miss, one of the a big communication equipment company, as they are trying to get a little bit competitive in that space with Amazon and other companies starting to muscle in what they do. So both of them look pretty ugly. Again, the market is looking to tip off here because we have mixed trade signals. You can see really big downward movement right now. Let's go take a look at the futures. Right here. We don't need to look at a weekly. We can look at a 2-minute chart today. And you can see right there, pretty big sell-off and then a nice bounce. It does look like right here, this is acting as a point of resistance, support at 224. If 224 is pierced below, it does look like we'll be returning to yesterday's low of 2,817. It looks like there is a potential chance for a recovery back to the 2,834. If it is met there, I would keep a watch to the next target right here on the S&P 500 at 2,840 would be my next target, looking at the futures. For some reason, looking at futures always slows my computer way down, particularly the S&P 500 futures for some reason. It really just doesn't like it. Let's go look at the YM futures. Now these are the mini Dow industrial futures. This is the Dow Jones futures as opposed to the S&P futures that we just looked at. And you can see pretty big spike down and now a chance for a recovery. We'll have to keep a watch right there. The levels look pretty much the same on the Dow. Now what's driving this market lower? Well, we have a trade war with China and the United States, and really that has nothing to do with the stock market other than an economical situation where countries are looking to raise taxes on international goods, and that could slow the economy down. So an economy will affect stocks because the businesses will report a slower growth in earnings or a decline in earnings. So that will directly affect the stock market. 2, we have a potential of the world going into a recession, which I've been saying that for months now. I almost sound like a broken clock at this point. I'm going to be right eventually if I keep saying it. But the data does suggest that Germany's slowing down, the EU slowing down, China's doing quantitative easing. They relaxed their credit limits on banks. Sorry about that. I don't know what it is. Whenever I hit this play button, my nose says, oh, it's time to sneeze a lot, Jake. And 2, we have the bond battle that's still going on, or the currency war and the banking war of who can get to negative interest rates and 0% interest rates the fastest. Right now it looks like Japan and the European Union are winning. And the United States yield does look like it's continuing to crash here. That rate cut by the Fed a couple weeks ago, well, they cut rates even more since then. You can see once again Treasury yields are lower as TLT is moving up and TBT is moving down. Natural gas did see a little pop today, and gold saw a little bit of a movement today. You can see right here gold continuing to look relatively strong in its upward movement. So both looking pretty strong. You can see silver, same trend, uptrend here, and palladium, copper, and platinum all look to be a little bit wonky here. Copper is not a precious metal. Copper is an industrial metal. You can see copper is not moving like the other silver and gold, the other elements, we should call them. We did have some economic news that came out today. We had CPI this week here. We had EIA petroleum status yesterday. We had jobless claims, Philly Fed. Retail sales still look relatively strong. Who knew that during the time of back to school, retail sales would be strong when everyone's getting their kid ready back, getting everyone's kid geared back up to go to school? Who knew retail sales would get a bump then? It'd be interesting to see what retail sales look like next month after all that has settled. We had the housing market index, and nothing huge. You know, business inventories too. I'd watch business inventories. Now, why would you look at business inventories? That's because they are a positive on GDP. So if business inventories build up, it's usually reflected on a positive for GDP. And you can see right here, they didn't move very much. So just keep that in mind. Now, business inventories are positive to GDP because it means that businesses are looking to build their surplus because they think that they'll be able to sell it quicker. It believes that a business is okay sitting on goods that they have in case the market is looking to pick back up. So they want to have all that inventory to have available to restock shelves. So that's usually why it's looked at as a positive towards GDP. CPI, or the rate of inflation, you can see that we had an actual nice little tick up month over month. Year over year, we're still below 2%, if you actually believe that. And you can see less food and energy, 3%, and you can see less food and energy year over year is 2.2%. You got to be really careful with inflation. You can look to Japan on how they handle inflation. They say there's no inflation, real big problematic inflation with Japan, but what you need to do is you need to go to a convenience store and you need to look at what you're getting as products. Has the product shrunk in size, but the value has managed to creep up a little bit? What used to be 100% juice now might be 50% juice, might be 25% juice. Meanwhile, the bottles are shrunk a little bit and the prices have moved up a little bit. So you're getting less juice, smaller product. That's actual inflation. When companies are trying to continue to make a profit, what they do is they shrink their goods. They add less juice, make the packaging smaller, just so they can continue to profitability. And that is happening in Japan. There's pictures of it. You can go look over the internet of products being shrunken. So inflation is around. Just because they're saying it's only 2.2%, it doesn't mean that there isn't more inflation to look at here. So that's always when I look at inflation here. We're at the central bank's target, but they've overshot that target so far. Looking at EIA petroleum status, you can see this week that we had not really a significant drawdown or buildup in any capacity. We did have a drawdown in gasoline that's slightly bullish for it, and distilleries had a drawdown with slightly bullish, but both of those numbers are not gigantic. We're looking at just a minor drawdown and a minor drawdown in distilleries. So nothing huge here. No real great numbers to take away from EIA Petroleum. It's kind of a flat number. You know, if we saw a 10 million barrel drawdown, that's bullish for oil. If we saw a 10 million barrel buildup, that's bearish for oil. If we saw a 5 million drawdown in gasoline, bullish for oil, bullish for gasoline. If we saw the inverse, you're really looking at 5 millions are usually the marker here. Anything below that is kind of just a static number. Nothing too big in the report in the economy there. Retail sales, you can see retail sales picked up month over month. But again, who knew that when kids go to college, they buy stuff before they go to college? Who would have guessed that one? You know, they buy books, paper, crayons, backpacks, clothes. This number is always going to be bullish this time of year, and when it's not bullish this time of year, you know there's a real problem in the retail sector. It's like retail sales the month before Christmas. Yeah, people are buying stuff. Usually you want to look at the numbers after those big events. You can see retail sales less auto, up 1%. Again, back to school. Less auto, 9%, and controlled group, 1%. So not bad there. Economists are going to use that to say, see, the economy is still doing okay. The retail people are still looking to go into debt. So just keep that in mind when it comes to that number. It's a little bit deceptive on how they're using it today. Looking at the housing market, you can see the housing market is once again slightly building up above the consensus rate, so that's not good for housing. And if we go right here and we go look at our European data and our global data, you can see that we had Germany CPI came in weaker than expected. We had the CPI in Britain, which was real wonky. We had the mortgage application. None of the economic data coming out of the world looks particularly great. I wouldn't trust housing price index in China, just because it's heavily subsidized by the government. And you can see right there, nothing too big to watch here. Basically, the big one was Germany's CPI and GDP, and it showed contraction. So we're pretty much past all the big news for the week. Economic-wise, we have housing starts tomorrow, but housing starts usually tick down a little bit going into the end of August because no one really wants to move before school starts. And you can see right here, prior was well within the consensus range, and permits were pretty much at the low end of the range. Housing seems to be troubled still, but because rates are continuing to lower here, real estate investors are still looking to pick up more property to flip. So this one thing to think about. The reason why I used Michael Lewis today, the author of The Big Short, he is the really big in shorting the real estate market, and I used him today because the real estate market is higher than it was in 2008, and more people are in more debt than they were in 2008. There's a couple different podcasters and personalities that I like to listen to, and usually one of them I like to listen to a bullish, and I like to listen to a bearish, and I like to listen to the middle of the ground. And this week my bullish person said something I was very unsuspecting is we might be in an everything bubble right now. And that was very odd for her to say. Usually she's very bullish, like, oh, the market's going to grow no matter what. The market year over year has still continued to uptrend, but for the first time ever she talked about the everything bubble, which I found fascinating. Usually I listen to her because she's my most bullish podcast. She's always like, yeah, the market's great, it could be a good investment, but now she's saying we're parked in cash. And when my bullish investor is saying parked in cash, it's usually something you want to pick up your ears and kind of keep a watch on. So keep that in mind. Oh, here we go. I did add Bank of America to today. The stocks that we are going to look at are going to be SPY, IWM, TLT, USO, GLD, GDX, SLV, Newmont Mining, Cisco, GE, Walmart, Bank of America, JP Morgan, and then any stocks you want to look at. We're also going to cover what to trade, what stocks typically do well in a recession, and those stocks would be our sin stocks, our alcohol, tobacco, and gambling stocks. It is a great movie. What I like about that movie is my parents actually understand what's going on. For years and years and years, the way I explained how I trade options, they thought I was just breaking into cars. They thought it was more simple for them to believe that I was going to car and stealing radios and selling it that way than how I was trading options. And I set them down, had them watch The Big Short, and they're like, oh, you're doing hedging against stuff like that. And I was like, yes. For a while, they thought I was doing like the movie Boiler Room and The Wolf of Wall Street, and I was like, I'm doing nothing like that. I don't have any news on the sell-off. The difference between looking at the ES futures now and the SPY, since it's within the same trading days, is the ES futures is a little bit more liquid. This is more of an S&P 500 play. The SPY, you can trade both 2-minute charts. I was looking at the futures. The futures are a little bit more liquid. The SPY is beta weighted, and it usually moves a little bit slower. So that's why I was looking at this to straight ES. But if you want to trade the SPY over the ES, there's no problem trading either one or the other. They are both very liquid. They both have high volume. I just like looking at the ES because it's a little bit more liquid than the SPY, and usually it will move quicker to the downside or to the upside in a range faster than the SPY, typically. Not always, but typically. So that's why I like looking at the futures over the SPY. So that's a pretty good question. But you can trade either or. There's time value, holding cost, built into place, an actual index. The SPY is based off, the SPY is an ETF. There are multiple future contracts. Each quarter, new one expires, like options. Yeah, I just like the ES because it's a little bit more liquid. When you see those big down moves, they typically, you can ride them a little bit easier. For the ES here, there's a lot of things built off the ES. VIX contracts are built off futures. So I just like looking at that when the market starts moving. You can see also, if we go look at the actual futures here, future contracts expire. So you can see the August one expires in 4 days, 6 days, 8 days, 11 days. There's different contracts, and there's if you've never traded the ES futures, I would not recommend today being the first day you do so, because there is so much you have to learn when it comes to futures contracts. Future contracts, the market could be closed, and you could lose your entirety of your account with the market being closed through a future contract. That's pretty scary. And if you don't know why, I would not recommend you trading those future contracts today. I just like looking at the future contracts today as just a determined trend. Future contracts can get pretty scary very quickly. Pretty good question. Let's see here. It's getting close to Andy's target. So, first up, let's go take a look at the SPY. Now, this week has been pretty volatile, to say the least. The trend right here still looks like this 283 level looks to be the area of support. Now, if we do pierce below this 283, I'd watch out below the 280. To say this trend is wonky is the best I can do. We are finally starting to form some sort of sideways range. You can see right here between 293 and right here 283 seems to be the range that we are currently trading in on the S&P 500. Let's go back to the line here. So we do have some nice channels. We finally have some nice little trend to look here. But keep in mind, this market can move 100 points. The Dow Jones can move 300 points in a snap, one tweet here. So just because things are moving back to flat, the Nasdaq's still kind of getting hit here, and the S&P 500 trying to move flat, it doesn't mean that the volatility is over. So where's the real risk in this market? Well, the real risk is another gap up right here, back above the 288. Or a potential movement down. We are pricing a nice floor in right now in this market. It's pretty interesting to see that we've tested it 1, 2, 3, 4 times now, and we've bounced back every time. So this 283, 282 level looks to be pretty strong area of support, though. Just because it looks like an area of support doesn't mean it can't continue to move lower. There are a couple things that you want to keep a watch here. One, if tariff talks increase here, and Trump actually initiates tariffs on Huawei and telecoms for China, it's going to be bad for the market because China is going to retaliate. Remember, it's Huawei or no way. When we had that nice market recovery early in the week, it's because Trump capitulated and talked about not putting on tariffs on the telecoms. That is the big hang-up for the tariff talks right now. It's Huawei, the Chinese telecom. Any news that comes out of tariffs on that or breakdowns in talks with Huawei, it's a big deal, and you need to watch on it. That is the biggest sticking point for the tariff war that we're currently in. Huawei is a big competitor in Europe, in Asia, and it wants to kind of grow in the United States. It is like the Chinese Apple, AT&T, and Verizon all wrapped into one. They want to be a big 5G producer. They have their own smartphones. So it's a big deal for China to have Huawei, anything to do with Huawei. Huawei being the big telecom there. So keep that in mind. That could drive the market up or lower. If Trump says, oh, you know what, we're gonna form a trade deal today. We're gonna let Huawei products be back in the United States. Market's gonna move up. Market's gonna move up because that's what China wants. But any news that there is going to be no deal on Huawei, the market's gonna sink back down. So keep that in mind. Okay, talking about BYND. Okay. Whew. My nose is running today for some reason. It's probably because I hit that play button. So, keep that in mind when you're doing your ranges here. Right here seems to be about the midpoint of this range, about the 288. And if we do move above the 288, you can see yesterday from that big movement higher, it did touch that 292 and came back down. So if you are doing short options, you are doing some option play around selling some premium, you want to be either below these targets here or above them. The market looks really scary right now in this trend. Are we forming the potential leg for an M? You can see right there, we're forming kind of an ugly M to move lower. Or are we going to potentially move up here? Well, what are the cases for the market breaking down? One is that the global recession is upon us, and it's going to start compounding here. And two, is the mentality of the market going to shift into more recessionary plays? Because remember, the market does have a mentality to it. And if the market thinks that, hey, recession is upon us, time to start moving into defensive areas, well, typically bonds, gold, and sin stocks do well here, and the stock market will see a little bit of a dip. So you want to keep that in mind. 3, are bond yields going to continue to move lower? If that's the case, it could potentially sell off the market a bit, though when bond yields move lower, typically you see a rotation out of bonds into equity because of the yield. So keep that in mind. Now, why would we see a bullish move here? Well, trade talks come together. China and the United States finally forms a trade talk for this tariff war. It's good for the market. 2, we see the central banks stepping in to do more quantitative easing, more rate cuts. That's typically bullish for the market. Typically, though, looking at the last rate cut that we've had, it's not been so bullish for the market so far. So you want to keep a close watch on those two. Overall, the trend right now, I'm staying in cash until I either get a confirmation of above 293, 294, or I have a confirmation of a breakdown at 282. Looking at both these levels, until I get confirmation on either one of these, I'm parking in cash and waiting. Now, if you do want to play the SPY, you can. There is volatility available. So there is some option premium if you do want to play a little bit of maybe a credit spread here. You can see that we are at 50% implied volatility percentage, and we're currently sitting still at the highs of the year for implied volatility. So there is some profit, there is some credit to play here in the markets. Just understand that you do not want to do short positions in the SPY right now because of the moves that potentially could be in place, because hedging will be expensive. So if you do your cash secured puts, your short calls, understand that to hedge those trades with volatility being this high, you're going to be paying a premium for that hedge. So if you are going to be playing with some options here, the short option side, I would highly recommend having the hedge already in place. The hedge being that maybe you're doing a back ratio spread. Back ratio spread, whereas you buying 2 short puts or 2 short calls and buying one long put if you're doing the put side and 1 long call if you're doing the short side. You want to do it that way. You don't want to go naked into this market without a hedge. Then again, your risk tolerance could be different than mine. That's fine. I'm just letting you know now, having survived a lot of horrific moves in the past, you want to have that hedge in its place because, yes, you can roll that position if you need to and wait for volatility to contract, but hoping that volatility contract is not a trade plan. Hoping and dreaming that the trade comes back in your favor is not how the trade. You need to plan this trade. And I'm letting you know now, having that hedging in place will help you sleep better at night. So when volatility is high like this, you want to have your hedge already there. You want to have your exits already written down. You want to have your entries really tight and your exits for those entries really tight as well. Having lived through volatility before, that will keep you in the game longer than just hoping that the market goes up or hoping that if you go short this market, the market continues to ride lower. So keep that in mind. You want to have these hedging in place. Typically, I like to keep it really tight, so I look at about 3% of my entry price. I look for that. So if it moves down 3% from where I entered, I like to exit. Now, you can keep it 3%, 5%, but you want to keep it a little bit tighter here just in case the market has movements like earlier, right when I started the movement. Today's meetup, you can see when we have these big shifts down, it could have easily continued moved lower. And you can see that we are recovering pretty nicely right now. Nice little V-shaped recovery. Though, if you are looking to option trade here and you do want to see if there is some premium, you can see that there is some pretty good premium right now. The 15-day out options, you can see you can look at, that's right here. If we go our deltas, of 3. You can see that there is some profitability here to be made. 23 cents, 18 cents is, it's a little thin there. 30 cents to the 255. That puts us at well below a 3 standard deviation move. 3 standard deviation move being a 99% move in the underlying price of the options. And with 15 days, it puts us right about here. So you can see that there is a little bit of premium to extract here. When implied volatility gets wide, typically you can also play some spreads. And if we go look at a potential spread play, you know, you can look at like maybe like a 260, 250, walk with like 20 cents if you massage the premium right. So 260, 255 with 15 days left to go. So typically when there's implied volatility, you can start looking at your credit spreads. When there's no volatility, that's when you start looking at your debit spreads. But right now with the implied volatility expanded, it's looking pretty good. Now volume is a little bit lighter today at 67 million. Usually the SPY sits at about 74 million for for volume. You can see right there about 70 million. Okay, it went down a little bit. So we are a little bit light in volume today, so just keep that in mind. Volume has been light this week, which is really surprising. When we got that big dip in the NYSE, we were actually at significantly lower volume. So really interesting that. Though it's typical this time of the year, a lot of traders are currently on vacation. Though I bet you their vacation was cut short earlier this week when the market was down 800 points. So just keep that in mind. We are at low volume right now. This is a low volume time of year. These moves can be relatively quickly and violent. So if you are going to be longing or shorting this market, just keep one, a list of your entries and exit prices. Two, a list of your get out numbers. Say, okay, I'm going to take a loss at this numbers. And three, if you're going to do short options, have a hedge in place. You want to have that hedge in place because of volatility of where it is. And if volatility spikes, and volatility can definitely spike here, it's going to be very expensive to get that hedge, to buy that long put to protect that trade, to roll that trade, to make that trade into a credit spread. It's going to be very expensive to do so. So just already account for having that hedge in place. Hedging is, one, having the exit target. Two, having a long position to counter your short position. So you want to keep that in mind. Yeah, I know it can pronounce Yahweh. I call it Yahweh. Oh, no worries. Keep up. You can ask as many questions as you want in the trading room. That's not a problem. I say it because I always get tongue-tied whenever I say Yahweh. I always call it Yahweh. So next up, let's go take a look at the IWM. Now, the IWM is breaking down here today. You can see that we broke an important level of support today, and it looks to be moving lower. The reason is that there's a lot of uncertainty for banking sectors right now. There's a lot of uncertainty for industrials and materials. Both of those are big components of the Russell. You can see that unlike the S&P 500 that's formed a nice little range, the Russell is the most violent of the indexes when it comes to these flattening out ranges. You can see that the Russell is breaking down. The QQQs have a nice little range forming right here where it's trading inside of it. The Dow Jones, the DIA, is testing an area of support right now. So the Russell does look to be weaker. And it makes sense because there's uncertainty on what's going to happen with the trade war. There's uncertainty on what's going to happen in banking. If the Fed is going to cut rates here in September because they might have their hand forced, well, that's bad for small cap banks. That means their profitability is limited because rates are cut. That means they can only offer loans at a reduced rate, meaning their profitability is going to come in smaller. And if we're going to start seeing delinquency on loans, I'm not saying it's going to happen, but if it does happen, they have less of the ability to absorb those loans that are underperforming to loans that are performing. So it usually hits the small cap banks pretty hard. If we go look at the heat map of the Russell right now, you can see which sectors are currently getting hit the hardest today. Right here, right here. And you can see consumer discretionaries are getting hit hard. Financials look to be kind of mixed. Information tech is really wonky today. So the Russell's having kind of a weird day. Industrials are mixed. Financials are mixed. Materials are right here are mixed. Consumer discretionary. So Diva's doing really good. Domino's Energy, which Domino's Energy is a big utility company. So if we do get a Fed that says, okay, we're going to cut interest rates again, bearish for the financial sector, particularly small cap companies. If we get no resolution for the trade talks, what's happening in the world, Well, that's bearish for materials and industrials inside the Russell because we don't know if these companies can continue to charge more for the goods and services they do. They can also be getting hurt because some of these companies, they don't produce all the goods they need in-house, and so they have to buy some of them out of house, and they're going to have to buy those at a premium, and so that means they have to shift those costs on their consumers, and their consumers might go somewhere else to buy those, and so that's uncertainty for these small cap companies. Now, there'll always be a leader inside the sector, don't get me wrong, but for a whole, it leads a big uncertainty into the sector as a whole. So the Russell looks to be continuing to weak here. If there was one I would avoid looking to short options on, it would be the IWM. I would not look to do IWM options here right now. I would wait for a correction or a retracement higher. And as is right now, it looks like it wants to break down. Now, looking at the Russell here for the potential breakdown, if we do look at our Fibonacci retracements, let's go back to the IW, Wall Street IO charts for that. Right here, we use our Fibonacci retracements. You can see that we are breaking below the 38.2. Now, I used this year's low as my low point for the Fibonacci extensions, and I used this year's high, or the last high of 6 months, for the Russell. And you can see right there, we're sitting at a 38.2 retracement. If it does move lower, we're looking at a 142 for potential for the next price target, all the way down to the 61 retracement at the 138. So you want to be very careful on Russell shorts. You don't want to be playing with volatility in the Russell because it's double beta weighted against the S&P 500, and if there's an expansion in implied volatility, it's going to compound really quickly in that margin in your account. So I would not recommend any type of shorts on the IWM unless it has the hedge in place, particularly because of that double beta weighting against the S&P 500. Can you elaborate on hedging? If I am long on calls, do I need to buy puts? So, if you're a long call, how do you hedge a long call? Well, sorry about that. So, you could buy a long put. You could also sell a call against your long call if you want to hedge that way. You could buy puts, but it does kind of negate the trade. So, if you think the market's going to continue to move up, or it moves down in your long call, there's a couple things you can do. One, you can get out of the trade. You can just take that position and close it right then and there, and that is hedging, is protecting yourself for downside, having that number written out. Okay, if it gets here, I'm out of the trade. Two, you can sell a call against your long call. So let's go take a look at it real quick. Yes, it would make IV expensive on that put too. So you can make it into a spread. So let's go take a look at the SPY. We're going to look at the, let's go 43-day out options. Just because theta is going to start, if we're long a call, we don't want theta to be eating too much of our position. Let's go like a 64. We don't want theta to eat some. It's going to eat some. So say we are long the 284 long S&P 500 call. We could potentially, to hedge this trade, we could sell maybe like a 294 against it. So we have hedging to the downside. So we have about $3 to add to that. So $3 that give us enter in a little bit of a debit spread. Or, sorry, enter a wide credit spread. So we get a little bit of credit, so it does protect some downside there. So if the call continues to move lower, we have that 294 that's losing in price, but we also have that 283. So we have kind of a weak spread. So you could do it that way. I wouldn't. You could buy a long put to protect against it, but at that point, why don't you just close the long call? Close the long call and wait for the market to recover at that point, because you can see the cost of entry here is $960. The cost of entry here is $926. So in this trade, you just put up about $2,000, so you could hedge the one trade to the downside. At the same time, you're going to be losing on theta. And if volatility contracts, you'll lose on both sides. Because if volatility contracts 1% on the S&P 500, on the 1% on this call, you're losing 47 cents. If volatility contracts 1% on this put, you're losing 47 cents. The stock could do nothing and just contract 1% implied volatility, and you lost on both sides. Now the turnabout is it can expand 1% in volatility, and now you just gained 47 cents on both sides. So you have to keep that in mind. Yes, you can buy a long put, but you got to watch the function of volatility. Is volatility high when you put on that long put? Because if it's high, volatility contraction is something that you need to keep on your radar. So usually when I hedge is 1, I look just to close the position. Say, okay, if it gets to this price, I'm out. 2, I look to potentially selling a long call against it. You might be saying, well, Jake, doesn't that lock me into the trade longer and limits my upside? Yes, it does. That is one of the risks of putting that spread there. It kind of locks you in a little bit longer because there's 64 days left in these options. So keep that in mind. Those are 2 things you want to look at. And also, you could roll the position into a higher delta. So the delta right now is 53. If you think the market's recovering, you could potentially roll this call into a higher delta, like a delta of 70, but I wouldn't recommend that. That's if you think the market's going to turn really quickly there. And remember, that delta compounds really quickly. So you could roll in that position too, but I'd be very careful in that one. So those are how I would hedge. I would look to say, okay, if this option gets to $8, I'm out. I'm just out. I have that number written down. 2, turn into a spread. Say, okay, maybe I'll sell a 294, maybe a 295. Now, I chose the 295s and 294 because it still gives me some upside potential with some downside protection. You can make it tighter if you want. You can sell like a 290 if you wanted to. Turn it into a little bit of a debit spread. You limit your upside gain for downside protection because remember, you're going to get $5 to protect that 9, so really effectively you're in the trade at 4. And you want to watch volatility as a function if you're going to be buying a long option to hedge your long option, because the market could go flat, and if the market goes flat and volatility contracts, you lost on both sides. Not only did you lose, the market goes flat on the put and the call because of theta, but you also might have lost because of vega. So you might have lost double the Greeks there. So buying a long put to hedge a long call is usually not the most efficient way. Now you might, if you really have conviction in that trade and you believe that you just want a short-term protection, and you think that call is going to, you think the market's going to recover long-term, but you want to just short-term buy some protection, you could buy a shorter time frame put, so maybe like a 13-day. You see it's only going to be at $4 as opposed to that $9. But understand, you're buying something with a lot of theta decay that's really susceptible to vega as well. And in 13 days, that protection's gone. In 64 days, you still have that trade on. So there's something to think about when it comes to hedging. Hopefully that answered your question for you, Ed. GE is currently under investigation for money laundering, so that's a problem. It's in the news today. Let's go take a look right here. So that's why I brought up GE today. GE shares drop. Here it is right here. Bigger than Enron fraud. So that's why I'm bringing up GE today. We'll talk about their fundamentals in a minute. Ooh, way over in time. I don't usually use Reddit as a news source, but when I skim Reddit, whenever I see stock market news, I like to see what's going on, because usually when an individual equity will make the top page of world news and news, it's something I like to look into, something I might not have think of, because this is kind of a tabloid news section, but sometimes it gives you ideas that you haven't been looking for. It'll bring something to your attention that you haven't been looking for, and it could potentially give you some profitability. So that's why I do like skimming the Reddit news section for when individual equities post up. Oh, you're welcome, Ed. Yeah, hopefully that explained for a little bit in depth there. You could also So you can look at risk profiles and what hedges a call. Well, you can short the stock too. But again, that has its own risk. And what would a long call and a short stock, what would that trade profile look like? Well, that would be the same as a short call, if you're wondering about risk profiles. A long call short stock would be the same thing as a short call credit spread, with the exception of a downside protection, because you think the market might potentially be moving flat, so you're looking at that position. It's really interesting. You are covered to the upside for that trade. So just keep that in mind. It's not a bad idea to go look at risk profiles of trades and look at what could potentially hit your trades. There's plenty out there. And it's real easy. I mean, if you go long call, short stock. I mean, look at that. Short call definition. I mean, it literally shows up the first in Investopedia. It has the same risk profile. Long put. So, just keep that in mind. It's always fun to look at the risk profiles. Yep, there it is. I guess we can caveat into GE really quickly here. I want to show you something in GE. I used to have GE in my portfolio. I bought long-term protection against it because volatility was completely crushed on it. And I bought long-term protection against my long GE stock when it paid a good dividend because it looked like a pretty good dividend play. Then Andy pointed out something that I didn't look at. And Andy's a pretty wise investor and trader. If you've never asked Andy questions or picked his brains, he has been trading for a significantly longer time than I have, and he's a very great resource to bounce trades off of and ask about the economy. He's been around. I've been around for 2 recessions in the stock market. He's been around for a lot more, so he knows how they typically play out. And he's been around for the Enrons, Sun Marketing, a bunch of them. And he pointed out, well, GE's in a lot of debt. And if we go look to incomes to sales on GE, GE sells pretty close to Microsoft levels in sales. You know, they make between GE and 3M, you can pretty much run an entire hospital. The machinery, the plastics, you can pretty much run that hospital between those companies. They make a lot of goods and services, GE. But the problem is their previous CEO, to spur growth, he did share buybacks, they did GE Capital, they did life insurances, and to make the company look more profitable than it was, they shifted money around. And if we go look to the income and sales, for a company that makes $118 billion in sales every year, it should have at least some type of positive income. And look at that negative income. That means they got a lot of problems on their books. And you can see right there, they've been hit with downgrades. They got hit with a couple upgrades. So short-term GE might have some problems here. You can see that there has been some insider buying, which is good, but it's getting kind of scary for GE, and you can see it coming back down. Now, I bought GE at $30, and I hedged at 25. I bought it at 30. I hedged at 28, I believe. And I bought 565 days on that long put, and I exited it earlier this year. I put that stock to someone else. GE is most likely, if that's the case with money moving around, they might have to cut the dividend again. You can see they already cut the dividend from 12 cents to 1 penny, and now it's looking uncertain that they'll continue to have the dividend. Now, their sales are good. Their earnings are good, but their books are looking very scary. So I would avoid anytime you see Enron and Bernie Madoff together, you might want to be a little bit cautious on entering this trade. Though, GE makes a lot of goods and services, so eventually it will restructure, but what will it look like after that restructure is the question. I mean, they provide a lot of jet engines for Boeing. They're working on the cloud for the machines to teach machines how to build products and how to repair products. So they do have a lot of good things in the company. It's just their financials are very ugly right now. So keep that in mind. That's something that you want to kind of keep watch here if you're looking to long-term invest in GE. They have a problem with their fundamentals on their books. Doesn't mean their products still aren't good. It's just mean that they mismanage their money pretty badly, and it's going to cost them, and it is costing them. They have insurance. For some reason, GE Capital had life insurance plans and all sorts of other weird financial planning they've done. There's just to spur growth. The last CEO put them in a lot of debt, and he really mismanaged the company. So you want to be careful here on GE, on going into any long right now. I mean, it could look attractive. I mean, it's only at $7, moving to $6 for a company that makes $118 billion in sales, but they don't make any income off of it. They're actually negative income, which is a problem. How can you be a company that should be the size of Microsoft, not make any type of return on capital? I mean, look at this. Microsoft only sells $125 billion a year. They make $36 billion in profitability. Next time you're at a hospital, touring the place, not being a patient of it, hopefully, they make MRI machines, imaging machines. They make surgical equipment. They used to make light bulbs. They don't make light bulbs anymore. So it is something that you want to keep on your radar. If you're looking to long-term hold GE, kind of be careful here. You can see aviation, healthcare. Aviation is going to be big for them. Aviation is going to start picking it up again as we enter in a new space race era. They help make rockets. They make rocket parts. They make engines for jets. And as we're moving in towards more of a shipping dynamic with Amazon uses a lot of planes, a lot of jets. GE provides a lot of jet and jet engine repair for Boeing. So just keep that in mind. They're one of the biggest oil and gas providers for natural gas through Baker Hughes. So they do have a lot of good stuff going for them. It's just right now their fundamentals look so ugly on their balance sheet. So once those fundamentals, they either file for bankruptcy or restructuring, then it might be an interesting stock to look at. But right now, be careful on GE if you're looking at this company. Option-wise, I mean, $7, you can look at 23 cents. The option volatility is massive on GE. Look at that volume today. 308 million shares traded today. That's more than what traded on the SPY, Apple, Microsoft, the VIX, the UVXY. You see, there's just massive volume right now on GE. I'd be very careful here. But I would keep it on your radar long term once it's restructured, because it has a lot of goods and services. I mean, their book value alone, if we go look at the book value of GE, its book per share value is $13, and it is trading below, it's Microsoft. Which, by the way, the book per share value is $4. So if it continues to crash here and we start getting into that 4, the 3s, you might want to keep a watch on it. But again, fundamentally wise, this is an ugly place to be. That's all I wanted to bring it up. With that being said, though, let's go take a look at bonds. I think I've rambled on enough. Let's go take a look at bonds and talk about where they're heading to. Now, we have seen the first time in a long time that our 20-year bonds are sub 2%. The actual rate of inflation in the United States is about 3% if you account for dollar weakness. Year over year, the Fed, the federal government, the federal government will print more and more dollars, weakening the power of the dollar. So that's called dollar depreciation. When you print more dollars, it weakens your currency, and year over year, you get about a 3% weakness in the dollar. So that means if I were to buy a 30-year treasury bond today, and the rate of currency depreciation is 3%, I would lose about 1% a year buying this bond. By the end of that 30 years, my bond would be significantly weaker, and that purchasing power that I received back would have lost due to inflation and dollar depreciation. There was a time this year when the 10-year bond was yielding 3%, the 10-year bond. Now we have a 30-year bond issuing less than 2%. What does that tell us? that tells us that there is capital flight into protection of bonds right now. Because remember, when people start buying a lot of your bonds, you can price them at less of a yield. So people buy a lot of your bonds, the bond prices go up, but the bond yields go down. So people are locking up their money right now for less than 2% in our treasury yields. I do have treasury yields right now. There was big news this week that the yields have been inverted. Now, what does a yield inversion mean? Well, that means that typically there's either short-term yield inversion, which means that short-term yield is now yielding higher than long-term yield, or there's the inversion the other way where long-term yield is now moving higher than short-term. Now, here's the actual U.S. Treasury yield curves, and we can see that. Here's 1 month curve, 2 months, 3 months, 6 months, 1 year. You can see right there, they're still okay. The 30 year is still yielding higher than the 1 month, but it's starting to get a little bit wonky here. The cost of borrowing looks to be a little bit skewed. I can get a 1 month treasury yield for 2.4%, or I can get a 2 year for 2.5%. So the yields are starting to kind of get scary. So keep that in mind. Typically, now here's the actual yield curve. Sorry, I'm going to pour myself some water real quick. I went from having a runny nose to a stuffy nose. Go figure. It never fails. Here's the actual yield rates right here. And you can see that the 1 month yield rate is below the 7 year, the 1 year. So that's a problem. That's telling us that, hey, if I want to borrow 10 years, it's cheaper than borrowing for 1 month. And a lot of businesses, they fund month over month for to keep their businesses going. So that tells us that there is a flight to safety right now. The yield curve inversion just means that the cost of borrowing short term has gone up over long term, and you can see it right here in the actual yield curve rates. The 1 month is now yielding higher than the 10 year. The 20 year is yielding pretty much the same as the 1 month. So that's kind of scary. And when you go through the Series 7 trading, which is what you need to obtain a FINRA license to actually trade on the stock market floor for options and stocks and some commodities and mutual funds, they go over yield curve inversion. That's actually a big chapter, is bond yields. And they go over what a yield curve inversion means. And they say that typically 6 to 12 years after the 10 year and the 2 year, the 10 year and the 3 year invert, there is typically a recession looming 6 to 12 months in the future. That's actually in the textbook for the Series 7. They go over that, which I found fascinating. So when you see a lot of hedge fund, mutual funds, retirement funds going on CNBC and other news talks saying, oh, there's a recession looming because the yield curve is, that's actually taught. I have the book right next to me where it's in the FINRA, the test for the Series 7 license. So keep that in mind. If it's in a textbook that's government approved, that tells you something. So people keep watching that. It tells you there is a capital flight to safety, and it's getting expensive for companies to fund their businesses when yield moves up. If I am a company that has to get a line of credit, or I have to get a new line of credit every 3 months or 6 months just so I can continue funding my business, what a lot of businesses do, it's more expensive for me to fund 1 month, 2 month, 3 month than it is 10 years out. And that's a problem. That's a problem for businesses. So what does that mean for TLT? Well, one, that tells us that bond yield is really low right now. So that tells us that bond prices should be pretty high for our 20 plus out year bonds. And that's what TLT is. It's the 20 year plus bond ETF. So that tells us that those prices should be relatively high. And if we go look at the chart, you can see that that's holding true. You can see that in the last couple days that we've broken out to all-time highs for as far as I can go back on TLT. There is a current capital flight to bonds. There is fear in the market because typically when the market is uncertain of what's going to happen with the economy, they move from equity to bonds. They move to a flight of safety of bonds because bonds, at the end of 20 years, typically you get your money back plus You get your principal plus some yield, and when there's uncertainty in the market, people want to park some money there. Because if the economy is slowing, that means businesses are doing less business, so that means their profitability is lower, so that means that they're going to be returning less on their stock. They're going to be returning less on potentially increasing dividends. Bonds are typically the flight to safety. In the United States, bonds have been looked at pretty heavily because, as Stanley Druckenmiller said, the United States is the cleanest dirty shirt in the world when it comes to the bond market. We're currently yielding a positive rate of return on yield, as opposed to the rest of the world that has majority of it negative yielding. So you can still park your money here and get a little bit of a yield. So that's why the United States bonds are looked at so heavily. Looking at TLT here, it's still looking like a bullish trend. I do think it's way overextended, but this is a flight to safety area. When there's uncertainty, people move into bonds. TLT is heavily looked at as well. Looking at right here, as far as I can go back. So we're going to look at a max available weekly chart on TLT. I can only go back to 2003. 2003. We are currently sitting at a, as far as I can go back, lifetime high for the 20-year plus bond. What does that tell us? That tells us that yields are really low right now, and there is a big capital flight. I personally think that TLT should be a lot lower, but just because what I think personally doesn't make the market. I think bonds are way overextended to the upside. If there is some trade news and the global recession fears finally calm down, it will see a big dip below. So you do want to be careful here for TLT. The trend is still bullish though. You kind of have to follow the trend, and the trend is kind of parabolic bullish. The upside potential, according to the 2 standard deviation of the Bollinger Bands, are pointing to a 151. Though I do get worried when I see the Bollinger Bands move like this. That means there's a huge movement off the 14-day moving average. You can see right here, we traded a little bit off the 14-day moving average, and we came back to it, and we traded in a nice range here. This was a big deviation as well, but right here is massive. The price action just tells us fear in the market for this bond movement. Now, looking at this overall chart, it does look like the 143 looks to be an area of support, but if once that 143 is pierced below, we're looking at 138. Longing TLT, you're going to be trading a lot of fear, and once that fear is taken out of the market, you might be seeing a big dip lower. Though right now the fear is still into the market, so it does look like there's some upside potential. Just be careful here. You don't see bonds typically go parabolic with that without a return eventually. You can see we did have this nice downward action in bonds here once we increased rates, but it did normalize. It did normalize eventually. Now, if the Fed is going to cut interest rates in September, we do have a live FOMC meeting in September. I can show you that right here. That will send bond prices higher. Something to take note, though. In 2011, we had quantitative easing. 2013, we had the end of quantitative easing that talks of potentially returning rates a little bit higher. And bonds were yielding. Bonds were still lower than they are right now. We have not seen bond yields this low in a very long time. A very, very long time. And that tells us that, again, a lot of fear in this market. Cleanest dirty shirt in the world right now. So kind of be careful here. We haven't seen bond yields this high, we haven't seen bond prices this high even during the height of the recession that the last time we saw it. So be very careful there. If you are going to be longing TLT, I highly suggest you having your price targets in place. Not only do I suggest having your price targets in place, I highly recommend you having them written down and stapled to a wall in front of you, so you can just look at them just because of how high it is. 2, have an entry and exit price. Have your price targets. Have your middle price, your short-term price, and your long-term price, where you take your profitability at. Have those written down so you can look at them, so you can keep this as mechanical as you can, because bonds are very volatile right now. You don't want to have those numbers in your head. You want to have them written down in front of you somewhere, just because of where the volatility is. So, Here's the next FOMC meeting. It's going to be in September 16th. There is a conference afterwards. If they're going to cut rates, if their hand is going to get pushed by political pressure, they could do it as early as September. So I would watch right here for the potential movement in the bonds moving higher. Now that's a month away, I know, but if Powell comes out and cuts rates again, it's going to be bullish for TLT and bearish for TBT. So just keep that in mind. Again, if you're looking for a short right now and you think bond yields are going to continue to move lower, you can look at TBT, and it's currently sitting at a lifetime low as well. But I do think TBT and TLT are a little bit fear-oriented right now, and I do think there should be some contraction, because if you go look at stochastics on TBT, which is long bond yield, we're currently sitting at lows that we have not seen. We're at 1.79, which is significantly lower there. And if we go look at TLT for the stochastics, we are sitting at the highs right now at 94. So I do think there's a lot of fear in this market. I do think we're overdue for a pullback, but just because I think we're overdue for a pullback doesn't mean it's going to happen. I am looking to execute a long put if we do move below this 143 on bonds. That's where I'm going to look for my long put and potential get out price at 138, 137. Once we do see the reversion. We are forming a little bit of a doji today, so be careful here. This movement is parabolic up. If you're going to be entering long into this trade today, if you think bonds are the place to be, have that hedge in place. Because this is a parabolic up move. It's a lot of fear trading right now. So just keep that in mind for TBT. Next up, let's go take a look at gold, silver, Newmont mining, and we'll look at Cisco, and then we'll wrap for the day here, because I'm kind of going over in time. If you listen to someone listening to CNBC, you would think that low yields would be a positive for the market. Are they assuming that low rates would create an easy environment for business? Rates have been low for a long time now. I can't imagine. Well, think about this. If we went from a time of high interest rates to low interest rates, where credit was really tight and now credit freed up, we can go back to the 1970s when around Jimmy Carter and Paul Volcker, when you have housing rates at like 13%, 21% interest rates, and then they get cut. That frees up capital. That makes people who potentially couldn't afford a house can now potentially look at getting a loan. It frees up capital for people to put on a little bit more debt. When debt is high, when credit is high, it's expensive to hold on to credit card debt, to other types of credit debts. When credit is low, it's relatively inexpensive to hold that, so you can get people into a lot of debt. And so we've had a long history of time where credit has, historically, it's never been this low for this long. And so people have been piling into credit card debt. And when you pile into this much credit card debt, it augments prices higher to things. Housing has never been this high. The cost of an auto loan has never been this high. And when credit is easy and laxed, you can push out those debt limits longer, meaning that 15-year home loan is now a 30-year home loan. You're seeing more 30-year home loans in 15 years. Auto loans went from 2 years to 3 years to now they're looking at 10-year auto loans. And so when you're cutting interest rates, yes, that frees up credit, but the consumer is tapped. We've gone through such a long period of time where credit has been so easy and fixing has been so easy to do that why would I look to put on more credit card debt right now? I have a lot of credit card debt, not me personally. I have almost no credit card debt. All my credit card debt is due to dental work. Root canals are so expensive, by the way. And so, yeah, it would spur the economy. Lower credit rates would spur the economy, but the economy has been bullish for so long on this low credit that what is it really going to do at this point? The effects of lower interest rates really won't spur an economy that's already at the end of its cycle. There's no big new MacGuffin people have to buy. Yeah, sure, electric cars are cool, but I have an auto loan for the next 10 years. I'm not looking to get a new car right now, me as a normal consumer. There's no new iPhone I'm looking for. There's no boom in tech that the average consumer just has to have. I mean, yes, cloud and 5G are awesome and cool, but me as the normal consumer, I'm not like, oh, I got to get me that cloud right now. I got to get me in the cloud space. So it's not going to have the effect of what they want it to have because the consumer is tapped. And if you follow modern monetary theory, it's all about debt loads, and the people are tapped on their credit, so they can't put on a bigger debt load. So it's going to have not the effect they're looking for. I would go 60 days plus just because of theta. So for my trade for TLT that I'm currently looking at right now, I'm looking at the 64 days. I'm looking at the 138 long puts right here. That's what I'm looking at right here. Now you might be saying, well, aren't you looking for a higher delta? Don't worry, once it gets to that 38 where I'm looking at my entry, the delta should be higher. I mean, 1, 2, 3, 4, 5, 6, 7, 8. If we look at the gamma there times by 8, it should be a lot higher delta. So I'm looking for 64 days here because you can see the delta is only, or the theta is only 2 cents. Typically when I look for long options, I like to do 60 days plus. The longer the better for long options. If I can look at a 92, if the volatility was a little bit sweeter there, I'd look at the 92. But the 64, I plan on being in the trade for less than a week and a half. So that's why I'm looking at the 64. I don't plan on being in the trade for a particularly long time. Now you might be saying, well, why don't you just go look at like your 29s or your 22s? Well, theta decay. Theta decay really picks up there. So I'm looking to be in it short term for that long put. And for TBT, the trade I'm currently looking at is right here. I'm looking for a long call, same time frame. I'm looking at a return to this gap right there. That's where I'm looking my entry to be for TBT. Rates going lower is positive development. Yes, it's positive for the economy, but the economy has had short rates for a long time. I mean, are corporate buybacks going to increase when earnings have been continually slashed, guidance has been slashed quarter over quarter for the past year? Am I going to be looking to put on more debt and do share buybacks? Not really. I have enough where I need to be right now. Am I looking to buy a new car? Well, consumers are tapped from a 7 and 10 year auto loan. So, yes, going from a period of high credit to low credit will spur the economy, but going from a time of low credit to slightly lower credit and a time when asset prices have already been augmented because of the high credit to low credit spread, not too much of a boom. I mean, housing in Fresno right now, the inventory is very low, but if you price a house for a middle income family above $250,000, that house is not going to sell for over 60 days. They pretty much have hit the price point of what they can squeeze the consumer for as maximum as they can at this point. So until either if lower interest rates spur the economy and wages go up exponentially, well, yeah, the lower interest rates will definitely help the economy. But we're looking at the end of an economic cycle. We're not looking at the start of an economic cycle. And you might be saying, well, we might be looking at 1995. In 1995, we saw a contraction. The market moved up higher. That's true. We could be looking at that. I don't have a crystal ball in front of me. But just looking at past economies and looking at trends right now, I don't see a big tech revolution that will get the consumer excited about buying a product to have a whole green shoots being something to kind of spur the economy growing. Yeah, 5G is cool. Don't get me wrong. I think 5G is cool about the data transfer, but you know the difference is between an iPhone 10 4G and an iPhone 10 5G? The specs are the same. I mean, you just changed one number up. So keep that in mind. Anyhow, I'm going way over in time here. Sorry about that. Let's go take a look at oil. We'll look at bonds, and then we'll wrap for the day. I do ramble. Andy is supposed to stop me from these ramblings, but you can see he's not here today. So, looking at gold, Newmont Mining is still moving in a nice range here. Newmont Mining has been heavily looked at because it is a big component of the miner ETF GDX. So, if you don't want to play the pure miner play of GDX, you could look at Newmont Mining. Newmont Mining also has exposure to copper, though. So, it does have a little bit of a copper play, so you want to keep that in mind. But overall, it's a big miner when it comes to gold and silver. So, usually what happens is once the big funds are full up in gold and full up in miners, the miner ETFs will start looking at the individual equities, and Newmont Mining is the biggest, most liquid equity inside of GDX. Looking at the overall range in GDX, it does look like we are consolidating here. So if we do break below 28.43, I'd keep a watch or return right there to the 27.70. You can see the miners are starting to consolidate here. We've had a nice run up here in the past couple months here in the miners. So it looks like we are a little bit overdue for protection, but this is a protective play. If you do think the economy is going to crash, gold is typically looked at and the miners are typically looked at. Looking at the overall strength in gold today, you can see we are still slightly rounding up here. I do have a next price target at 145 on the precious metal. This is where I do think the next target is if we can pierce above 143. If the Fed steps in and says, hey, we're going to do quantitative easing or quantitative transfer, ending that, it's going to add a little liquidity to the market, and that is potentially going to move gold a little bit higher. If we go look at the dollar today, the DXY, and we go look at a 2-minute chart, you can see the dollar has relatively strengthened today, which is typically bearish for gold. But you can see that gold is still catching a bid here. So we are seeing that the flight to safety is still on. When it comes to gold and the dollar, you're also going to want to watch the yuan. If the yuan continues to sink lower here, it could be potentially good for gold. A lot of the economies, the big economies in the world, have been stockpiling gold. And if you go watch Real Vision, they have a free channel on YouTube that you can go and watch. Every single guy that they have on this past week have been like, I think gold looks to be a pretty interesting undervalued asset right now. So that does tell us, if they are telling us they're looking at gold, that means they've already positioned themselves in gold. So keep that in mind. But that also tells us that they're looking to liquidate. So kind of be careful here if you're going to be longing gold. Looking at the overall spread at the futures, you can see that there is some implied volatility here. So you could potentially sell some premium if you wanted to in the precious metal. Again, if you don't understand how future contracts work, I would not recommend today being the day you go to gold futures and then start selling options on gold futures. You want to talk about compounding losses quick. If you have no understanding on how to do an option trade on the futures, today is not the day to enter that trade. So if we look at GLD though, there is some option premium you can look at here at the sell. You can see right there at around our 10 and our 11 deltas, there is some premium like the 136s, the 137s at 136, 137. That puts us right where this range where it picked up earlier last month. So just keep that in mind for gold. There is potential play for options here. Just keep in mind that the trend does look like to be sort of consolidating in a wedge here. Not so much like the parabolic move in TLT. But you can see we are forming a little bit of a consolidating upward wedge. So I would keep a close eye on here, because if it breaks, it looks like the next level is 140 for the strong area of resistance. And if that 140 breaks, you can see it's gap down, gap down. So kind of be careful there in that range for gold. Good questions today too, by the way. I really do appreciate them. Also, let's see here. Let's see if this is the right one. I can post this up as well. Let's see here if this is the right one. I do have a whole module about hedging that I can go over. I'll go over hedging next week. If the market's still volatile like this, I'll pull up my old PowerPoint on hedging, and we will go over exactly where I look at for hedging and what I do and what I don't do. I have to find it. We're over in time anyhow. So looking at oil here is still continuing trading within this big body candlestick. I'd watch for either a breakdown of 1124 or a break above 1188. Saudi Arabia and Russia aren't looking to cut oil production. If they don't cut oil production, it will be bearish for the price of oil, because OPEC is a big world supplier of it. Russia has a lot of pull on what OPEC is doing recently, because oil produces a lot of oil as well. And so if the global situation is starting to contract here and oil says, no, we're still going to produce as much as we can, bearish for the price of the commodity. So keep that in mind. You want to keep a close eye on this. We are well within this candlestick here, and we are kind of trending inside of it. You're either looking for a breakdown or a break above here. So keep that in mind for our precious commodity. Whew, a lot to go over today. So with that being said though, if you've not checked the University tab out in quite some time, there is a wealth of knowledge in here to check it out. Just today we have our new swing trading with Swallow class. He day trades every day, Monday, Wednesday, Friday. I highly recommend checking him out. He has a very particular, interesting way of trading that I myself like to watch every once in a while. He also has a class here that if you've not taken, once I can find it, It's a highly interesting, intuitive class that I think everyone should take here at least once. Also, it's only 4 lessons. Treat yourself. Learn a little bit about day trading, learn a little bit about how swap trades, and if you are new to the site, we have a whole host of classes on how to actually use the site. And if you have any questions, Nick posts a new video every Tuesday. It's a live class. Feel free to attend it and ask as many questions you can about the site. The more you learn, the better trading you should perform. And we have one of the best trading rooms on the internet. There is a wealth of knowledge of traders here today in this class. Ask questions, get insights, pick their brains, post to the community board. The more questions you ask, the more participation you do, the better your trading should become. We have a couple traders here today that can attest that themselves. So take advantage as much as you can of this site. Ask questions, ask comments, watch the videos. I can tell you now, having spent a lot of money learning the stock market, this is one of the best places to come to learn the market starting out. The videos we have here are some of the best videos you will ever see for the stock market. I myself have taken Micah's option class once or twice, and I've taken his stock market class. So take these classes, and it's been a while since you've revisited these classes. Watch them again. There are some classes on hedging, on how spreads work, and with the market being as volatile it is, it might be a good idea to take a look at how credit spreads work, and Micah has a good class on that in options. With that being said, though, this has been your portfolio growth. I'm Jake Pelly from Wall Street IO. Sorry I went over in time, everyone, but it looks like I'm going to do an hour and 30 every week from here on out. So get your stretching in beforehand so your legs don't fall asleep. And as always, from Wall Street IO, I'll catch you back in the trading room.